Good day, and thank you for standing by. Welcome to the Q3 2025 Steve Madden Ltd Earnings Conference Call. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To withdraw your question, please press star 11 again. Please be advised that today's conference is being recorded. I would now like to hand the conference over to your first speaker today, Daniel McCoy, CP of Corporate Development and Investor Relations. Please go ahead.
Thanks, Brittany, and good morning, everyone. Thank you for joining our third quarter 2025 earnings call and webcast. Before we begin, I'd like to remind you that our remarks that follow, including answers to your questions, contain statements that we believe to be forward-looking statements within the meaning of the Private Securities Litigation Reform Act. These forward-looking statements are subject to risks that could cause actual results to materially differ from those expressed or implied by such forward-looking statements. These risks include, among others, matters that we have described in our press release issued earlier today and filings we make with the SEC. We disclaim any obligation to update these forward-looking statements, which may not be updated until our next quarterly earnings conference call, if at all. The financial results discussed on today's call are on an adjusted basis unless otherwise noted. A reconciliation to the most directly comparable GAAP financial measure and other associated disclosures are contained in our earnings release. Joining me on the call today are Ed Rosenfeld, Chairman and Chief Executive Officer, and Zine Mazouzi, Chief Financial Officer and Executive Vice President of Operations. With that, I'll turn the call over to Ed. Ed?
All right. Thanks, Danielle, and good morning, everyone. And thank you for joining us to review Steve Madden's third quarter 2025 results. As anticipated, the third quarter was challenging, driven largely by the impact of new tariffs on goods imported into the United States. During the period in April and May, when new tariffs on Chinese imports reached 145%, wholesale customers cut back meaningfully on orders for the third quarter, and we shifted large amounts of production out of China midstream, which led to shipment delays. These factors, together with the negative impact to gross margin from the significant increase in our landed costs, resulted in substantial pressure on both revenue and earnings in Q3. Fortunately, while we will continue to see negative impacts from tariffs, we believe the worst is behind us. Order patterns from our wholesale customers are normalizing, and we are mitigating a larger percentage of the gross margin pressure through strategic pricing actions and sourcing initiatives. And most importantly, underlying consumer demand for our brands and products is strong. Despite the noise from tariffs, our team has stayed laser-focused on executing our strategy to deepen consumer connections through the combination of compelling products and effective marketing, and we are seeing those efforts pay off, particularly in our flagship Steve Madden brand. Steve and his design team have created an outstanding fall product assortment that is resonating with consumers and enabling us to outperform the competition. Boots have been the standout, led by our casual tall shaft styles. We're also seeing strong performance in dress shoes across various heel heights, as well as casuals like loafers, Mary Janes, and mules. Our marketing team is amplifying this great assortment with richer brand and product storytelling and increased investment across YouTube, TikTok, Snapchat, and Pinterest, which is driving measurable increases in awareness and conversion with our key Gen Z and millennial consumers. And as a result, both wholesale sell-through and DTC sales trends for Steve Madden have accelerated meaningfully in recent months. Our new brand, Kurt Geiger London, also has strong momentum as consumers continue to respond to its bold, statement-making designs and eye-catching marketing, including the current campaign featuring Emily Ratajkowski. Comp sales for the brand were up mid-teens in the third quarter. Overall, the acquisition integration remains on track, and our teams continue to make progress on revenue synergies, including expanding Kurt Geiger in international markets through the Steve Madden network and growing Steve Madden in the UK through the Kurt Geiger platform, as well as cost savings opportunities in areas like freight and logistics. We are also making meaningful progress in advancing our other owned brands. In Dolce Vita, we're building on the outstanding success we've had over the last several years in our U.S. footwear business by expanding in international markets and extending the brand into other categories like handbags. And in Betsey Johnson, we are driving renewed cultural relevance for the brand with elevated talent partnerships, authentic community engagement, high-impact activations, and differentiated merchandise assortments. Both Dolce Vita and Betsey Johnson are on track to deliver revenue gains for the full year 2025, despite the headwinds from tariffs. So in sum, while the third quarter was undeniably challenging and our financial results were not up to our usual standards, our team's disciplined execution of our strategy is strengthening our brands and building relevance and demand with consumers. We are confident that we will begin to see improved financial performance in the fourth quarter, and looking out further, that we have the brands, business model, and strategy to drive sustainable revenue and earnings growth over the long term. And now I'll turn it over to Zine to review our third quarter 2025 financial results in more detail.
Thanks, Ed, and good morning, everyone. In the third quarter, our consolidated revenue was $667.9 million, a 6.9% increase compared to the third quarter of 2024. Excluding the newly acquired Kurt Geiger, consolidated revenue decreased 14.8%. Our wholesale revenue was $442.7 million, down 10.7% compared to Q3 2024. Excluding Kurt Geiger, our wholesale revenue decreased 19%. Wholesale footwear revenue was $266.5 million, a 10.9% decrease from the comparable period in 2024, or down 16.7% excluding Kurt Geiger. Wholesale accessories and apparel revenue was $176.2 million, down 10.3% compared to the third quarter in the prior year, or down 22.5% excluding Kurt Geiger. The majority of the organic decline in wholesale revenue can be attributed to tariff-related order reductions, shipment delays, and other impacts related to the production disruption. In our direct-to-consumer segment, revenue increased 76.6% to $221.5 million. Excluding Kurt Geiger, our direct-to-consumer revenue increased 1.5%. We ended the quarter with 397 company-operated brick-and-mortar retail stores, including 99 outlets, as well as 7 e-commerce websites, and 133 company-operated concessions in international markets. Our license and royalty income was $3.7 million in the quarter, compared to $3.5 million in the third quarter of 2024. Consolidated gross margin was 43.4% in the quarter, up from 41.6% in the comparable period of 2024, due to the impact of Kurt Geiger, which has a much higher mix of DTC than the legacy business, and therefore has higher overall gross margin. Wholesale gross margin was 33.6% compared to 35.5% in the third quarter of 2024, due to pressure from tariffs, partially offset by our mitigation efforts. Direct-to-consumer gross margin was 61.9% compared to 64% in the comparable period in 2024, due to pressure from tariffs, as well as the addition of Kurt Geiger, which had lower DTC margin in the quarter than the existing business, driven by the concessions business. Operating expenses were $243.4 million, or 36.4% of revenue in the quarter, compared to $174.2 million, or 27.9% of revenue in the third quarter of 2024. Operating income for the quarter was $46.3 million, or 6.9% of revenue, compared to $85.4 million, or 13.7% of revenue in the comparable period in the prior year. The effective tax rate for the quarter was 23.4% compared to 23.8% in the third quarter of 2024. Finally, net income attributable to Steve Madden Ltd for the quarter was $30.4 million, or 43 cents per diluted share, compared to $64.8 million, or 91 cents per diluted share in the third quarter of 2024. Moving to the balance sheet, our financial foundation remains strong. As of September 30th, 2025, we had $293.8 million of outstanding debt and $108.9 million of cash equivalents, and short-term investments, for a net debt of $185 million. Inventory at the end of the quarter was $476 million, compared to $268.7 million in the third quarter of 2024. Excluding Kurt Geiger, inventory was $275.6 million, a 2.6% increase compared to the same period last year. Our CapEx in the third quarter was $11.6 million. During the third quarter, the company did not repurchase any shares of its common stock in the open market. The company's board of directors approved a quarterly cash dividend of 21 cents per share. The dividend will be payable on December 26, 2025, to stockholders of record as of the close of business on December 15, 2025. Turning to our fourth quarter 25 guidance, we expect revenue to increase 27% to 30% compared to the fourth quarter of 2024, and we expect earnings per share to be in the range of 41 cents to 46 cents. Now I would like to turn the call over to the operator for questions. Brittany?
Thank you. At this time, we will be conducting a question and answer session. As a reminder, to ask a question during the session, you will need to press star 11 on your telephone. You will then hear an automated message advising your hand is raised. To withdraw your question, please press star 11 again. One moment while we compile our Q&A roster. Our first question comes from the line of Paul Lejuez with Citi. Your line is now open.
Hi there, this is Kelly on for Paul. Thanks for taking our question. Ed, you sounded pretty positive on what you're seeing on the fashion front. I'm just curious if you could talk more about how you're seeing the fashion develop this fall, how inventory levels in the wholesale channel are looking, and if that makes you think differently about sort of the prospects for spring, particularly in the wholesale channel.
Yeah, good morning, Kelly. Yeah, we feel really good about what we've seen in fall. As we mentioned, we've seen a pretty meaningful acceleration in the trends, particularly in that core Steve Madden women's shoe business. And as I called out, I think the biggest driver has been boots. Our boot assortment has just seen really strong performance. We called out that it's been led by the casual tall shaft styles; those have been most important. But we've got a number of other things working in the boot and bootie category as well. And then, as I said earlier, it's not just about boots, because we've really seen a nice improvement in the dress shoe category. That's obviously a category where we think we have a really strong competitive positioning, and our team has executed there. And we're seeing strength in a number of different sort of looks within the dress category, and as I mentioned, really at various heel heights. And then casuals have been important too. So the fashion sneaker business has downshifted a bit, and we're picking that business up, and then some in loafers and mules and Mary Janes. So really feeling better than we have in some time about our fashion in Steve Madden and how it's performing. And yes, it does give us confidence going into spring. And I think we feel better than we did a few months ago about how spring is shaping up.
Great. Good to hear there. And then on the 4Q guide, well above sort of where consensus is looking, could you just break that down a bit for us in terms of what you're expecting from the core relative to the kind of down 15% you saw in the third quarter, whether there's any shifts there or what's kind of driving any acceleration there, and just what you would expect from KG in the fourth quarter?
Sure. Yeah. So the core business, if you exclude KG, the revenue guide is essentially down 2 to down 4, and that includes increases in both wholesale footwear and DTC, but still a decline, offset by a decline in wholesale accessories and apparel. And then the KG contribution to revenue, I think at the low end, we're at 182 and the high end, 187.
And any sense of sort of the breakdown when we think about our models and how much of that KG revenue is coming from the DTC channel in the fourth quarter and what kind of impact that'll have on the grosses?
Yeah, I mean, as you know, overall KG is over 70% DTC. I think I'd have to, I mean, I want to say it's probably about $135 million, something like that, in the fourth quarter coming from DTC, and obviously that does have a meaningful mix impact to gross margin.
Got it. Thank you. Best of luck.
Thank you.
Thank you so much. Our next question comes from the line of Anna Andreeva with Piper Sandler. Your line is now open.
Great. Thank you so much. Good morning and congrats. Nice results. A couple of questions. Are you seeing stockouts in the core Madden business, just given everything that's going on with the supply chain? And how quickly can you chase? Great to hear about DTC XKG bouncing back to positive. And Ed, you mentioned a strong consumer response to a number of categories, but can you parse out how own e-com did versus brick and mortar? And how does the 10% reduction in China affect your thinking about sourcing?
Sure. Yeah, look, are there certain styles where we've had stockouts? Yes. But generally speaking, we've been able to chase some of the additional demand in the core Steve Madden business. As you point out, because of the supply chain disruption, we don't have the ability to chase that we normally do and the speed that we normally do. But we did front load some merchandise here because we had good reads on these products, and so we were in a position to fill some reorders, for instance, in Steve Madden. And then also some of this product is coming, or a good portion of it's coming from Mexico. And obviously that's where we have a lot of speed and we can get back into reorders in 30 days. So that I think has been an okay story. I think the second quarter was about e-commerce versus bricks and mortar. In both Steve Madden and Kurt Geiger, e-commerce is outpacing bricks and mortar, but we've seen we talked about the acceleration in Steve Madden. We've seen that in both e-com and stores in recent months. And then in terms of the final question, I think it was how does the China reduction impact our sourcing? Look, it's obviously it's a welcome development to see the reduction in the tariff on China. The way that this tariff regime looks right now, the math would tell us we would move quite a bit back to China. I think that we're going to be careful about that. We want to remain diversified. We don't want to get back into a position where we have 70+% of our sourcing coming from one country. And so we're going to continue to try to be diversified, but it obviously does give us greater flexibility to go back to China where we need to get the right deliveries and quality, pricing, speed, etc.
Makes sense. No, thank you for that. Just as a follow-up, as we think about the KG rollout plans, as we look into next year, just any color you could provide how we should think about the store growth versus wholesale? Yeah,
well, we will be. We're going to, I think, not get into a lot of detail about 26 overall because we'll obviously be talking about that on the next call. But I can tell you that we do plan to open a handful of stores in the United States next year for Kurt Geiger, and we're working on those plans now. But as we've talked about, the initial 6 stores in the United States are performing very well. And so we're getting pretty close on a handful of leases for next year to continue that rollout. But there'll be some wholesale growth as well because I think that we have opportunity in both channels.
Awesome. Thanks so much again.
Thank you.
Thank you so much. Our next question comes from the line of Jay Sole with UBS. Your line is now open.
Great. Thank you so much. And I think I heard you say that legacy Steve Madden should be down 2 to 4% with wholesale footwear and DTC positive. Can you just talk about how you're thinking about 4Q for the entire wholesale footwear segment and then wholesale accessories? That'd be helpful. Thank you.
Yeah. Wholesale, including Kurt Geiger or excluding Kurt Geiger?
I guess excluding Kurt Geiger.
Excluding Kurt Geiger, wholesale footwear, we're looking at up 2 to up 4.5. And wholesale accessories and apparel, excluding Kurt Geiger, still down mid to high teens.
Got it. Okay. All right. So that makes sense. And then I guess if you think about Kurt Geiger retail versus wholesale, I mean, how are you thinking about that?
Well, we provided the DTC revenue for Kurt Geiger, which I said I think is going to be around 135, and then the overall number for Kurt Geiger, 182 to 187 is the range.
Okay, understood. Got that. Thank you for clarifying that. And then I guess just you've asked to start a couple times, but just on your visibility, I mean, have you taken orders? Did you take orders earlier for Kurt Geiger relative to the Steve Madden business? I mean, do you have visibility out into Q1 and Q2 yet for Kurt Geiger, or is it going to be on the same sort of quick turning supply chain that Steve Madden is on?
No, we do take orders earlier there, and so we'll have more visibility over time there.
And I guess any comment on sort of the order book and how that's shaping up right now?
I think we're going to postpone all discussion of 26 until the next call. But look, the Kurt Geiger brand continues to perform very well, and we're going to see growth next year.
Got it. Okay. Thank you so much.
Thank you so much. Our next question comes from the line of Aubrey Tianello with BNP Paribas. Your line is now open.
Hey, good morning. Thanks for taking the questions. I wanted to ask on Kurt Geiger as well. Appreciate the comment on comp sales up mid-teens. Any color you can share on how Kurt Geiger performed by region in the quarter?
Yeah, it's growing in all the core regions. So they performed well in their home market of the UK. It continues to grow in the US, and we're also growing in Europe.
Got it. And then you've talked about the revenue synergy potential there, and one of the first pieces of that being, plugging KG into your existing international markets. I know it's still early, but any updates on that in terms of how that's progressing or when you could start seeing some of those benefits?
Yeah, we've been hard at work on that. The Kurt Geiger CEO just went on a world tour. I think he hit, I want to say, 4 continents over a 3-week period, meeting with all of our international teams and international partners. And so that work is underway, and I think we'll start to see some benefits in 26. Probably more, I think anything that will be meaningful to the numbers would be towards the back end of 26.
Got it. Thank you.
Thank you so much. Our next question comes from the line of Marnie Shapiro with the Retail Tracker. Your line is now open.
Hey guys, thanks so much for taking my question. Your stores have really looked beautiful. Could we just focus a little bit on some of your smaller but growing areas? It sounds like the handbag business was a little bit disrupted. I'm guessing some late deliveries. I'm curious if you could just talk a little bit about what's going on there. And then can we get an update on the apparel business, both at stores like Macy's, Bloomingdale's, and Revolve, as well as Madden NYC at Walmart?
Yeah, sure. In terms of handbags, look, that's obviously been a category, if we're talking about Steve Madden handbags, that we have talked about all year was going to be down based on the excess inventory in the channel and some of the market pressures that we've experienced there. That was we came into the year expecting that business to be down double digits. That's been exacerbated by all the tariff disruption and everything that's happened with the supply chain and deliveries and everything else. So we've certainly felt a lot of pressure there, and we're going to continue to feel that in Q4. The good news is that the underlying demand, I think, is improving, and we've seen good sell-throughs in fall so far, improved over spring. We've got a number of things working there. I think that our unlined hobos, shoulder bags, east-west bags, anything in brown suede. So we've got the trends, and they're performing. And so I do expect that business to stabilize as we come into spring 26. And then apparel, as you know, has been a nice growth story for us. The focus, of course, is Steve Madden apparel, and that's a business that we've been, the sell-throughs have been good, and we've been steadily growing it in those key accounts that you mentioned, Nordstrom, Dillard's, Bloomingdale's, Top Doors of Macy's, Revolve, et cetera. And then to your point, we also have the mass business that we do with Walmart under Madden NYC, and that's an important business for us as well. Although our overall business in the mass channel, has definitely felt some pressure from tariffs, and so we expect that to get better as we go into 26.
And then can I just follow up on what's going on the bag side in the department stores? I'm sorry, in the shoe side in the department stores. Are you seeing a big difference between the higher end stores that you sell, some of the better stores, or I guess even more fashion stores? We have Revolve is a much more fashion store than some of the others, versus stores that are a little bit less fashion, or it's across the board, your sell-through has been good, and there's not a lot of price resistance to the Madden brand when the product is right.
Yeah, we've been really pleased so far with the lack of price resistance that we've seen, particularly in the Madden brand. I think, as we've said, we have a lot of very strong fashion right now, and I think overall, if you look at the overall company, what the real takeaway on the price increases is that when you have real fashion-forward products or new fashion, the consumer is willing to pay. Where you have to be much more careful with price increases is on the core and more basic product. But the good news is that's how we did it. That's how we planned it. As you know, we were very surgical about it. We didn't take a peanut butter approach where we spread the price increases evenly everywhere. We went style by style, and so I think that so far we've been pleased with how the price increases have been have been received by the consumer.
Fantastic. Thank you. The product really looks outstanding. Some of the best product out there in the market. Best of luck for holiday, you guys.
Thanks so much.
Thank you so much. Our next question comes from the line of Corey Tarlow with Jefferies. Your line is now open.
Great. Thanks, and good morning. Ed, I was just wondering if you could talk to the AUR lift in the business. So you're selling $200 boots today versus sneakers that were more like $70 previously. So how is that affecting the business, and what's the impact on sales and comp? How do you measure that? And how do these fashion trends speak to what AUR could be next year?
Yeah, we are seeing a pretty significant increase in AUR, and it's really twofold. It's one, it's based on the price increases that we've put through in response to tariffs, and number two, it's, as you point out, there's a mixed benefit due to selling more boots and in higher price categories. So in Q3, in our DTC, we were up about high singles in AUR. In Q4, we're running more like mid-teens increases in AUR.
That's really helpful. And then it does feel as if there's a bit of a tone shift in your commentary around wholesale, where kind of the first half of the year I talked about order cancellations, and now you're talking about orders ramping back up. So I'm curious if is this the fact that the channels are doing better, or is it that you see Steve Madden gaining more market share in these channels? How do you think about that?
I think it's both. I think, if my tone didn't get better from how I was talking when we had 145% tariffs and everybody canceled every order, then it would be pretty depressing. But so look, some of that, the external noise has abated a bit, and so we're, I think things are normalizing in the wake of all the tariff disruption. But in addition to that, we are also seeing improved underlying demand, improved sell-through, and that's causing the wholesale customers to come back to us with more aggressive plans.
Got it. And then if I could just squeeze one more in, it seems like the product's resonating really nicely. Intuitively, what do you think that means for promotions, and what's embedded in your outlook for that? Thanks so much.
Yeah, I mean, the good news is we have been able, for instance, in our DTC channels, we have so far in Q4 reduced promotional days by a pretty meaningful amount compared to what we were doing last year. So we've been able to be less promotional because of the strength of the product and the trend. And we'll obviously we need to remain competitive when we get into the fall, the heart of the holiday season here when everybody's promotional, but we're going to attempt to continue to be less promotional where we can.
Great. Thanks so much, and best of luck.
Thank you.
Thank you so much. Our next question comes from the line of Tom Nikic with Needham. Your line is now open.
Hey, good morning, guys. Thanks for taking my question. I wanted to ask about the margin structure of the business. So obviously, 2025, between tariffs and, the acquisition and, maybe, some tough first half of the year at the core brand or a tough first 9 months, there was quite a bit of margin erosion this year. How do we think about how much of that is recoverable and how much may be structural? Thanks.
I'd like to think all of it is recoverable over time. I think it's going to take a little bit of time. I don't expect us to get it all back in 2026, but certainly, over time, I do believe that the tariffs are going to find their way into the retail prices, and we'll be able to get back to our pre-tariff margins in the core business. And then the Kurt Geiger business is obviously lower margin than the legacy business, but we think that business has a path to getting to where the Steve Madden levels or potentially even higher over time. So that's the goal.
All right, sounds good. Thanks very much, and best of luck this holiday season.
Thank you.
Thank you so much. Our next question comes from the line of James Ross with Williams Trading. Your line is now open.
Hey, good morning, and thank you for the question. Two questions, actually. The first being, how will the mix of business with the addition of Kurt Geiger impact gross margins in Q4? I know we kind of touched on it in the first question, but was hoping you could sort of dig into that a little deeper maybe. And the second being, can you provide some color on brand growth and opportunities internationally and what that looks like going into next year? Thank you.
Yeah, go ahead.
So as far as your first question related to Kurt Geiger impacting gross margin in Q4, I think it would be similar to what we've seen in Q3, somewhere around 300 basis points.
And I'm sorry, what was the second part of the question?
Yeah, and the second part was, could you provide some color on brand growth and just generally the opportunities internationally and what that looks like going into next year?
Is this about the legacy business or Kurt Geiger? Are you asking about Kurt Geiger or the legacy, the Steve Madden?
Yeah, so Steve Madden and then also Geiger as well.
Sure. Yeah, so Steve Madden, we continue to have nice momentum in international markets. We're for 2025, we're looking at high singles revenue growth, and that's very similar across the three regions. So very similar growth in our three key regions being EMEA, APAC, and the Americas ex-US. So nice momentum really across the board, and we'll look for continued growth into 2026. And then Kurt Geiger, as we've said, they're in the early stages of their growth outside the UK and the US, so we'll be looking for very strong double-digit growth internationally out of them for a handful of years here.
Wonderful. All right. Thank you so much. Best of luck.
Thanks.
Thank you so much. Our next question comes from the line of Janine Stichter, with BTIG. Your line is now open.
Hi, good morning. Just wanted to follow up on the margin recapture, if you could help us out. I think the tariffs you had said hit gross margin a little over 200 basis points in Q2. How much was it in Q3, and then how to think about Q4? And maybe help us unpack that, Kurt Geiger, between that and the core business. I think Kurt Geiger had been hit a bit more in the front of the year just because you hadn't been able to move as quickly there.
Yeah, so as far as the tariff impact in Q3, given all the moving parts with the price increases, factory discounts, our renegotiated costing, as well as FOB differential between all the countries, I think it's best to look at it from a growth and mitigated perspective. And Q3 was about 100 basis points more than what Q2 was. And I think you're asking about Q4 as well. I think it would be a little bit worse than that in Q4.
The Q4 is the 100 is mitigated, and it'll be worse in Q4 versus Q3.
So Q3 was about 100 basis points worse than Q2, and we expect Q4 to be a little bit worse than Q3.
But those are unmitigated, and so the mitigation gets bigger over time. So the net impact to gross margin will be considerably less in Q4 than it's been.
Understood. Okay, and then just maybe on the mitigation, just wanted to clarify on pricing. I think you took 10% increases earlier this year. Have you taken more, or do you plan to take more?
That's where we are right now. We'll have to look at it as we go forward. And that obviously is still not enough to offset the full amount of the tariffs. So over time, we'd like to see if we can take more, but we want to be prudent about it.
Perfect. Best of luck.
Thank you so much. Our next question comes from the line of Dana Telsey with Telsey Advisory Group. Your line is now open.
Hi, good morning, everyone. As you think about the wholesale business, what differed by type? Were there off-price, department stores, mass? What did you see, and what do you think of the outlook going forward? And then on the DTC side, was there a difference between full price and outlet performance? Thank you.
Yeah. So in wholesale, I would say we're seeing the strongest performance in the regular price channels. Where we have had more pressure is in the value price channels like the off-price and the mass. In terms of DTC, we're seeing much better performance in full price channels. Outlet remains a drag. And I think, we're being hurt by a couple things there. One is, 5 of our biggest 8 outlet stores are on the border with Mexico, and those stores are running down about 40%. And so that's been a big headwind there. And then the other thing is that I think we were impacted more acutely there by some of the disruption from the supply chain in the wake of tariffs. So outlet has still been trending negative, and full price stores have been much better.
Got it. And then just on the value side of the wholesale channel, Are they just not taking orders? Are they waiting for newness? Are they waiting for more goods, not accepting the price increase? Any way to articulate it?
Well, they were the ones that pulled back most significantly. Again, it was during the period in April and May when China tariffs were 145%. They are coming back now, and we're seeing those businesses normalize. But that was where we felt a big part of the pullback in the last couple of quarters.
Got it. And just lastly on marketing, as you think about Q4, anything we should be watching on the marketing side, given your improved social that you've had in terms of marketing as we head into the holiday season? Thank you.
No, we're just going to continue to keep doing the storytelling. I think that we see it's working. I think our marketing teams are hitting the bullseye, and we're just going to keep investing and keep telling and keep engaging with consumers.
Thank you.
Thanks, David.
Thank you so much. Our next question comes from the line of Paul Lejuez with Citi. Your line is now open.
Hi, it's Kelly again. Thanks for the follow-up. I just wanted to follow up on an earlier question around the KG margin structure. In your disclosure that you said KG was about 9% EBIT margin business in F24. Curious where that's going to shake out this year with the tariffs, and then as we look at 26, how much can you recover? Can you get back to the 9% next year? And just longer term, I mean, you spoke pretty positively about KG margins. Where ultimately do you think this business can land, and how do you get there? Is it through SG&A synergies? Anything in the gross margin to speak about? Just any color on sort of how we should think about the KG margins as we look forward. Thanks.
Yeah. In terms of this year, for the partial period that we own them from May on, I think that they're going to come in around 6%. In terms of next year, we'll talk in more detail about that on the next call, but certainly we should see improvement from where we were today, or from where we were this year. But I think we'll postpone any further discussion of that until that call. And then in terms of the last one with the drivers to get the longer term, I think there's opportunity in both gross margin and SG&A, but I think the bigger opportunity is in SG&A. There's some cost savings opportunities that they're going to get from the combination with us, which we're already, all that work is already underway. But we also think there's a significant opportunity to just leverage operating expenses over time as we grow that business.
And just curious where you maybe think that those margins could go longer term.
Yeah, I think what we said earlier was that certainly the intermediate target would be to get to where Steve Madden, the legacy business, was historically, but we think there's opportunity beyond that.
Got it. Best of luck. Thanks.
Thanks, Kelly.
All right. Thank you so much. I'm showing no further questions at this time. I would now like to turn it back to Ed Rosenfeld for closing remarks.
Great. Well, thanks so much for joining us today. We hope you have a wonderful day, and we look forward to speaking with you on the next call.
Thank you for your participation in today's conference. This does conclude the program. You may now disconnect.